The American economy seemed strong. Unemployment was low, people were spending money, the stock market was booming, new tech companies were emerging, investors were excited about the future. But beneath the surface, trouble was brewing. Interest rates had been low for a long time. This made it cheap to borrow money. Companies and individuals took on more debt than they could handle. Inflation started to rise, making everything more expensive. The Federal Reserve, America's central bank, tried to control inflation by raising interest rates. This made borrowing more expensive. Meanwhile, the world was facing multiple crises. The war in Ukraine disrupted supply chains. This led to shortages and higher prices for essential goods. Climate change caused extreme weather events, damaging crops and infrastructure. These global challenges added to the economic uncertainty. Despite these warning signs, many people remained optimistic. They believed the good times would continue. They kept investing in the stock market, pushing prices even higher. This created a bubble where asset prices were inflated beyond their real value. When the bubble finally burst, the consequences were severe. Looking back, there were plenty of red flags. Housing prices had been skyrocketing, making it difficult for people to afford homes. The cryptocurrency market, known for its volatility, experienced a major crash earlier in the year, shaking investor confidence. Experts warned about the dangers of rising inflation and unsustainable debt levels. However, these warnings were often ignored or dismissed. Politicians, eager to maintain a positive economic outlook, downplayed the risks. Financial institutions, driven by short-term profits, continued to engage in risky lending practices. The media, focused on sensational headlines, often failed to provide in-depth analysis of the underlying economic issues. Even ordinary Americans, caught up in the excitement of a booming economy, overlooked the warning signs. They continued to take on debt, invest in risky assets, and spend beyond their means. This collective blindness to the looming crisis would have devastating consequences. Pinpointing the exact cause of the crash is difficult. It was a combination of factors that finally tipped the scales. One trigger was a series of major corporate bankruptcies. Overextended companies, burdened by debt and facing rising costs, finally buckled. This sparked a wave of panic selling in the stock market. Adding fuel to the fire was a loss of confidence in the financial system. Rumors spread about major banks holding massive amounts of bad debt. Investors, fearing a repeat of the 2008 financial crisis, rushed to withdraw their money. This created a liquidity crisis, where banks didn't have enough cash on hand to meet withdrawal demands. As the crisis unfolded, the interconnectedness of the global economy became painfully clear. The American market crash sent shockwaves across the world. Foreign investors pulled their money out of the US, further weakening the dollar. Stock markets around the globe plummeted in tandem as fear and uncertainty gripped the world. While the crash had many contributing factors, the actions, or inaction, of several key players exacerbated the situation. Large financial institutions, driven by greed and a culture of excessive risk-taking, engaged in reckless lending practices. They provided mortgages to unqualified borrowers, packaged these risky loans into complex financial instruments, and sold them to unsuspecting investors. Corporate executives, focused on short-term profits and inflating stock prices, prioritized shareholder value over long-term sustainability. They engaged in stock buybacks, enriching themselves and other wealthy shareholders while neglecting investments in research, development, and employee wages. Government regulators, tasked with overseeing the financial system and protecting consumers, failed to adequately address the warning signs. They were often influenced by lobbying efforts from powerful industries and failed to implement stricter regulations to prevent excessive risk-taking. This lack of oversight created an environment where reckless behavior flourished, ultimately contributing to the severity of the crash. Section 5. Freefall. The market crash and its immediate aftermath. Once the downward spiral began, it was swift and merciless. The stock market, which had been reaching record highs, went into freefall. Major indices like the Dow Jones and the S&P 500 plummeted by double digits. panic selling gripped investors as they desperately tried to unload their stocks. The crash quickly spread beyond Wall Street, impacting businesses and consumers. Companies were forced to lay off workers and cut back on investments. Consumer confidence plummeted, leading to a sharp decline in spending. The government scrambled to respond. The Federal Reserve slashed interest rates to near zero. Congress debated various bailout packages. These measures would take time to have an effect. Millions of Americans faced an uncertain future. Section 6. Main Street Blues. The crash's impact on ordinary Americans. For ordinary Americans, the market crash wasn't just about numbers on a screen. It was a life-altering event. Millions of people watched their retirement savings evaporate overnight as the value of their 401ks and IRAs plummeted. Home values, which had been steadily rising for years, began to decline, leaving many homeowners underwater on their mortgages. The job market, once a source of optimism, quickly deteriorated. Layoffs swept across industries, from manufacturing and construction to retail and hospitality. Even those who managed to keep their jobs faced pay cuts, reduced hours, and increased workloads. The unemployment rate, which had been hovering near historic lows, skyrocketed, exceeding levels not seen since the Great Recession. The crash exposed the deep inequalities that had been festering beneath the surface of the seemingly prosperous economy. Those who were already struggling, low-income families, communities of color, and rural Americans, were disproportionately impacted by the crisis. They faced higher rates of unemployment, food insecurity, and housing instability. The American dream, once a beacon of hope for so many, seemed increasingly out of reach. Section 7. Picking up the pieces. Government response and initial recovery efforts. The government faced immense pressure to stabilize the economy and provide relief to struggling Americans. The Federal Reserve cut interest rates to near zero and provided liquidity to financial institutions. These actions helped to prevent a complete financial meltdown. Congress passed a massive stimulus package to stimulate economic growth and provide assistance. The package included tax cuts, infrastructure spending, and expanded unemployment benefits. It also provided aid to struggling industries like the auto and banking sectors. While these efforts helped, the road to recovery was long and arduous. Section 8. Lessons learned or not learned. Preventing future economic disasters. The 2024 market crash served as a stark reminder of the interconnectedness of the global economy and the devastating consequences of unchecked greed and excessive risk-taking. It highlighted the importance of strong financial regulations, responsible lending practices, and government oversight to prevent future crises. One of the key lessons learned was the need for greater transparency and accountability in the financial system. The complex financial instruments that contributed to the 2008 crisis were still being traded, often with little understanding of the risks involved. Regulators vowed to increase oversight of these instruments and to push for greater transparency in financial markets. Another important lesson was the need to address income inequality and create an economy that works for everyone, not just those at the top. The crash exposed the deep disparities in American society, with those at the bottom bearing the brunt of the economic fallout. Policymakers began to consider policies aimed at reducing income inequality, such as raising the minimum wage, expanding access to affordable health care, and investing in education and job training. Section 9. The long road ahead, rebuilding trust and fostering a more resilient economy. While the immediate crisis had passed, the scars of the 2024 market crash ran deep. Trust in financial institutions and government regulators was shaken. Many Americans felt betrayed by the system, believing that it was rigged against them. Rebuilding that trust would be a long and difficult process. Beyond restoring trust, the challenge was to create a more resilient economy, one that was less prone to boom and bust cycles and more equitable in its distribution of wealth. This would require a fundamental shift in thinking, away from short-term profits and towards long-term sustainability. It would also require a renewed commitment to investing in education, infrastructure, and innovation. The road ahead would be challenging, but the 2024 market crash offered an opportunity for reflection and reform. It was a chance to learn from past mistakes and build a more just and equitable economic system for all Americans. A generational wake-up call. The 2024 fall market crash was more than just a financial crisis. It was a societal wake-up call. It exposed the flaws in our economic system and the deep inequalities that plague our society. However, amidst the wreckage, there was also hope. The crash sparked a national conversation about the kind of economy we want to build. It ignited a desire for change, a yearning for a more just and equitable future. The road ahead will be long, but the lessons learned can guide us to a better future.